In March 2020, the world went into a very strange phase. People were scared for their health, for their wealth, and for their future. As a portfolio manager, it's been my job to calm people during these kinds of times. I did it in 2008, I did it in 2016, and in 2020, when the COVID-19 pandemic overwhelmed the world and the stock market. But 2020 was different. It was a new wave of uncertainty that none of us has ever seen. I know what it's like to feel scared about the future, and I hate the thought of any of my clients dealing with that on top of everything else they face. We thought about how to reach our clients and those who counted on us for financial education in a quick and to the point format. Good evening, I'm Charles Brown with CB3 Financial Group, and welcome to our first ever Facebook Live session. And CB3 Live was born on March 12th, 2020. We've been on two different platforms in two different cities, and now with over 50 episodes behind us, we've ridden this wave of COVID-19, political uncertainty, and economic upheaval. We've found new friends along the way and built an amazing community in the process. This episode marks the 1-year anniversary of CB3 Live. I and my team want to thank you from the bottom of our hearts for the support you've given us and this show. It truly means the world to us. I'm excited about the growth not only of the show, but in the country in this last 12 months as we continue to look positively towards the future for a better America, a better stock market, and better lives for all of us. I look forward to watching the growth in Season 2 of CB3 Live. And I look forward to saying each and every week, from COVID to the U.S. political scene to the world economic scene to clarity, this is CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, March 11th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad that you are here tonight to join us for our 1-year anniversary show. I've already seen comments in the chat box with people saying, how could it have been a year? Well, in some ways it seems like a lot less than a year. In some ways it seems like maybe 3 or 4 years just with the hairs I've lost getting the show out. But anyway, we're excited for tonight. Really, really excited. It's the 1-year anniversary. We're going to look back. We're going to look ahead, and we're going to have a good time. We're going to talk a lot and dialogue with each other. Just reminding you guys, if you know somebody that's not online tonight, send them to the YouTube link, okay? Have them click the link to subscribe to our channel. Also, have them click the bell so they get the updates. Subscribe, and they'll be able to see whenever we go live, which sometimes is more than Thursdays. Also, follow me on Twitter. I tweet every single day, sometimes more than once a day, Facebook and LinkedIn. Before I get into the actual program tonight, I'm going to do a shout out. 2 shout outs. The first one is to Heidi Steiner, who has been my graphic artist since May. And if you saw that first scene, I'm sure you did, right? It's hard to believe it's metamorphosized from that into what we have today. But Heidi is responsible for all the graphics. She could not be here with us tonight, but she sends her best, and just real excited to have her develop now the Season 2 graphics, which you guys will start to see next week, okay? But the person responsible for this show even being here, Tom Brown from Inova Digital, is with us tonight. Tom is a video producer extraordinaire, cinematographer, video editor. And he called me the afternoon of Thursday, March 12th and said, you really just need to go live. You need to talk to your clients. 4 hours later and a couple emails, we figured out how to, send MailChimp. And we had, several dozen people watching the show. And here we are a year later. From Chicago, his office, Tom Brown, joins us tonight. Tom, welcome to CB3 Live.
Hey, how's everybody doing? Thank you for having me on the show, Charlie.
So really, the whole social media thing has changed how people can present themselves, so they can just go on an old guy like me who's never had any experience doing this a year ago, and you could tell in the footage. What are you seeing in your line of work that is driving this whole push towards webcast and social media connecting?
I think in general, people just want to connect, and doing things in a fashion like this that's live. I think that when I presented the idea to you and you kind of took on to it, it was a good way for your clients to interact directly with you. They didn't have to do emails behind closed doors. They could watch you on a weekly basis and have a chance to ask questions and get news fed kind of directly to them. So I think that all businesses kind of benefit from the level of transparency that can come from live videos and, social media content. So
you see more and more people doing these kinds of webcasts. I mean, is a large portion of your work doing these kinds of things or shooting commercials or what is it? And I know we're going to have a question or two probably over in the chat. If you guys have anything you want to ask Tom, go ahead.
Not a lot of my work is in this category, but I think that this is definitely an exploding category. I think, this is essentially a video podcast of sorts that has a live element so people can engage. And I think as time goes on, people are open to consuming more long form content like this. And you're obviously a specialized person, and what you have to say, people care to listen to. And you have an ability to hop online and stream very good quality to the world, and do it every week. And I think that as businesses and as people figure out that it's not that bad and not too hard to do, I think that there'll be an increase in live stuff, especially.
Awesome. Well, Tom, here's the shout out from all of us. I see several people. Hey, thanks, they say to you, guys, for making this possible and continuing to give me production cues and things like that. So here's a question. How much does production value influence webcasts as a social media platform? Good question. Thank you, Tom.
I come from the video realm, so I think that it's easy for me to say that the more production value you have, the better your show is going to do and such. I don't want to say it's always like that, but there's no shortage of content these days, and there's no shortage of what I'd consider kind of premium content. I think, again, as time goes on, people's tolerance for kind of hokey is going to diminish a little bit. So you don't need to have a whole lot of stuff. Charlie, if you guys wanted to ask him any specific questions about the stream setup, he probably knows more about it than I do at this point. But there's a couple of moving pieces, but a lot of the stuff can be done with either just a cell phone or a laptop. So if you have your own business or thinking of doing something like this, it's fairly easy to get started and have a decent stream.
Excellent. Thanks for being here tonight, Tommy, and I look forward to working with you in year 2 as we continue to ramp up the production quality. Have a good one.
Yes. Thanks.
All right, guys. So in COVID, just like I said in the intro, we have 3 segments. We have COVID, we have the U.S. political scene, and we have the world economic scene. So in COVID, guys, really just getting to be more and more good news. Exactly 1 year ago today, and in fact, if you're watching the show, it's because you've chosen not to watch the president, who's literally live, I think, at this moment, talking about the 1 year anniversary. But 1 year ago today, the World Health Organization, WHO as they're called, declared this an outbreak. And of course, it just changed all of our lives. Economies were upended, nations locked down. History will probably be written and rewritten as to whether that was the wisest move, but everyone acted in the best knowledge that they could for their particular country. Every world leader did. Unprecedented amounts of monetary and physical stimulus poured into this economy, and people got used to staying at home. And of course, all of that is changing what we see as profitable investments because consumers and businesses alike have just changed how their proclivities are towards consumption. And that's, of course, the purpose of the whole show, is to monitor this and to continue to make the best investment decisions based on that. In the financial markets, the fastest bull to bear recovery on record was seen, as well as one of the fastest crashes, because it was only 5 weeks it took to go from basically market highs on Feb 19th of last year to the March 23rd low. Obviously, the Federal Reserve played a big part in backstopping this. The Fed was here in this pandemic more so than they were certainly in the crash of '87, and we've learned a lot from that. So we see going forward here, the rate of new infections and deaths have begun to fall. In fact, I think I predicted, 2 months ago, or close to 2 months ago, but the peak was going to be mid-January. That is the case. 62 million of Americans have received one dose of the vaccination. 33 million have gotten full vaccinations. You've seen this chart before, that the 2-week trend, this is going back a full year, just continues to plummet. I'm not even showing the number of deaths and hospitalizations because, candidly, we're on the downturn here, which is a situation that we want. We want to just keep moving forward with this mindset that we will be past this soon. So even while unemployment is still high and before the latest doses are out there, businesses have been complaining about labor shortages. Now, this is actually one of the reasons I have a special guest tonight who is in an industry where she has almost unlimited clients, but very, very high shortage, low supply, if you will, for labor. And we're going to get into that in just a few minutes. So 40% of business owners had job openings they couldn't fill. And I can tell you from our guest tonight, she's definitely in that category. The COVID-19 continues to disrupt the labor market. Some people can't find jobs. Other businesses can't find people to fill those jobs. And it's that dichotomy that I've been highlighting on this program really for the last year. You can see on the graph, basically, this is what it looks like for small businesses not being able to fill positions. It's literally at a 40-year high, even in a pandemic, even as we just recently exited the recession. I had this graph on here last week, and I'm showing it again because I just think it's pretty cool. I actually didn't have the graph. I had the information that, now there's so much money going out in these trucks with these vaccinations that the Wall Street Journal had an article calling this the security challenge worthy of a James Bond film. And it's good to see that we have trucks that have this many vaccines literally a year later. It didn't happen this quickly with polio, folks. It didn't happen this quickly with the Spanish flu 100 years ago. This has really been a miraculous turn that we can say exactly 1 year later that I showed you just a few graphs ago, 33 million Americans have been vaccinated, 66 million have received at least one. All right. So Disney World, got this from the Tampa Bay Times. Just yesterday, they are sold out for spring break. Now, they cannot fully have as many people there as they normally do during the year. But unlike Disneyland in California, as you know, the state of California and the state of Florida have very different economy opening principles. We'll get into that later in the show. But I think this is a great sign, especially if you are someone that's getting out of college on break and wanting to go down there. Very positive sign. An interesting stat here is what I've been calling the COVID baby bust. You would think with people staying at home that there would be more babies. This almost could have been baby boomer number 2 in America, but that's just not the case. Look at the number of deaths going up and the number of births going down. So this will affect consumer trends over the next couple decades, the rest of my life. And of course, when consumer trends are affected, that affects what investments are wise, and we have to follow this trend. But that is something that not many people saw coming. That many people thought that there would be a baby increase during this, and it's not been the case. So it's question and answer time, guys. Where are you now with COVID-19? Answer A, I'm realizing that life will be different for quite some time. In other words, just not a few months. You remember in the beginning of this, a year ago, literally tonight, we were saying, well, we think this is going to be a month or two. Well, obviously that was wrong. Answer B, I agree with states reopening right before spring break. C, I disagree with states reopening right before spring break. And D, I'm just kind of overwhelmed by all this news. What's next? So we're on this 25 second delay here. So I'm going to go ahead and just tell you a little bit about our guest while you guys are answering. So Lydia Thibodeau is in Boston. She has an enhanced nanny placement agency and specializes in placing college-educated nannies with busy professional families. So it's that partnering of those two that is unique to what she does. She recruits, screens, trains nannies, puts them through this training program called Savvy Sitters, and then connects them with families in Chicago, Boston, and the suburbs. And she has a problem. Her problem is she can't find enough people literally to make $100,000 salaries. All right, so now you know who we've got there. Let's look at our answers. So answer A, Dr. J, realizing life's going to be different for a while. Yes, we got a lot of C's here. Disagree with states reopening right before spring break. Okay. Hi, Karen. Good to see you. Answer C. Keith. B, I agree with states reopening. Okay. I knew this would be a little bit of a controversy here, but what else? What other answers we have, guys? Anybody else? At least nobody's overwhelmed. I'm seeing A's, B's, and C's. Okay. So during this pandemic, I like that, Charlie. Thank you with the hearts. During this pandemic, we've talked to people who have struggled to keep their businesses going because they cannot produce enough widgets. Their client base has just fallen off. Restaurant owners, movie theaters. But this person has just the opposite problem. And so I'd like to bring in Lydia Thibodeau right now from her office in Boston. Let's switch to Lydia. Are you there? Do we have audio? Lydia, speak up. Are you there?
Hear me okay?
Yeah, we can hear you okay. Good. So full disclosure, I have known Lydia since the day she was born as well. So thanks for joining us tonight, Lydia. So this pandemic has caused this tremendous worldwide unemployment, and yet your business has no struggles, from what you've told me, whatsoever to find clients. In fact, you desperately need nannies. Why is this so different than other employers who are experiencing this huge drop-off in their business? And I think you even told me that you had a placement for a nanny, and I think that the job paid $100,000, and there was 3 weeks of medical benefits, or 3 weeks of vacation and then full medical benefits. And the nanny, who was in her early 20s, turned down the job. How do you justify that? It just seems incredible, at least from what we've been talking about in this economy.
It's been very surprising to see. I think we felt like there might be some changes just around COVID, obviously, and working in an in-home setting. We did not predict what we're seeing right now. The need for nannies has gone up substantially, which has also driven nanny salaries to the highest I've ever seen, which is, outlined by what you just mentioned. People that previously had their children in daycares, or they used an au pair, foreign exchange student essentially, or they had their kids in school full time, which has caused the greatest demand ever. Which again has also driven up salaries really, really high, and nannies really get their pick of jobs. And, I think that's what's caused the most significant change.
So I've been a believer of demand and supply really controlling the capital markets. And it seems even something as unusual as a nanny placement agency, the laws of demand and supply work exactly the same. Basically, the clients have to continue to raise their offer to a nanny to get them to come. Because the nannies can literally pick any job that they want, is what it sounds like. By the way, guys, I see the first question from Tom Z in Lake Geneva. If you want to ask Lydia questions, go ahead and feed them now because of the 30-second delay we're on. So what are the unique qualifications that your nannies have that maybe just a regular agency that has au pairs or something like that? And do these unique qualifications make it difficult? I mean, must make it somewhat difficult for you to find top quality talent, even during a pandemic when you'd think people were wanting to work.
Certainly, that's the case. We require that our nannies hold a 4-year bachelor's degree, and about 30% of our candidates also hold a master's degree. That is very unique to our agency, both in Boston and Chicago. We're the only agency that has that requirement. I think in this climate, it's made it more challenging because a lot of women that have 4-year degrees and are perhaps teaching, which is, our ideal candidate, they see this as more unstable and they're not sure with all the uncertainty around a pandemic that they are ready to make a jump from a classroom, even teaching remote or even a daycare setting to
Hmm.
coming to work in home because they think with all the uncertainty around the pandemic and parents working from home, would they still have a stable job if things were to change and the vaccine was more widespread?
How many of them have expressed concerns about their health? I mean, obviously, females in their 20 somethings are among the least susceptible, as opposed to if I were trying to do a nanny job at my age. And because I'm a man, 68%, I think, of the victims have been men as far as the deaths. Have they mentioned that health was a concern for them too, or is it literally just this disruption of their schedule that you talked about?
It's surprising. I think the families are more safety conscious when it comes to COVID and worried about their health and their children's health. The nannies actually seem pretty flexible. I think that they understand that their personal lives are going to be a little bit limited based on what the family is comfortable with. For example, most families don't want their nanny dining indoors, traveling,
Yeah.
or getting together with large groups of people. But, to remain employed, that's something that they have to curb right now. But I haven't witnessed a lot of nannies being very concerned with the family's practices. But I also think that's due to the fact that a lot of our clients are physicians and they are very COVID conscious to begin with. So the nanny usually knows that she's going to be in a safe setting.
That's got to help actually if it's you're going to a doctor home. So how is your industry going to change to adapt to this and be able to sustain itself? Obviously, it'd be almost incredible to think a business could die out or an industry could die out without, if you have plenty of clients but not enough supply. But how will you adapt to this tightening labor market, and maybe more finely tune what the nanny skills are to the uniqueness of those two markets? And if you want to speak to the uniqueness of Chicago versus Boston, that would be great too. And then we'll take some questions.
I think that it's actually interesting, but Boston and Chicago have a lot more similarities than differences in what families are looking for and what candidates are looking for. Salaries are certainly higher in Boston, but that's just because the cost of living is higher in Boston. Both markets are looking for nannies that are college educated, specifically having backgrounds in elementary education, special education, early childhood development. I think that most families are looking for a skill set with house management as well, flexibility, willingness to travel. I don't see substantial differences, which is partially why we chose to expand to Boston versus a different city.
Sure.
And in terms of your other question and ways that we'll be, tailoring our search process moving forward, it's something that's I'm just constantly spending a lot of time figuring out how we need to do that. I had a focus group a couple of weeks ago with some of my top candidates in Boston and Chicago who have been working with our clients for a few years, just to ask them what the word on the street is with the nannies and how they're thinking of COVID and people that are leaving this industry and why they're doing so. That was really, really interesting. And I think the biggest thing I took away from that, and it could be something to do with the generation that we focus on, and it could be something to do with COVID and the fact that everyone's home, is that candidates really want to work with families where they feel like they're going to be part of the family.
Yeah.
They are not as inclined to work at a super, super high salary job, although that's certainly important. They really want to make sure that they're working with a family where they feel valued and heard and respected, and that they have job security. So that was
Literally being part of the
overwhelmingly
family.
the most important thing that candidates said.
Yeah, it's different than feeling like you're hired help. I get that. So let me get a couple questions here. So Tom in Lake Geneva says, what are the qualifications to be a wealthy nanny? I like that.
Again, the background in elementary education or early childhood education is huge. Most families look for that. We also look for 3 years of professional childcare experience, teaching, working at a daycare, nannying, but non-friends, non-family, polished, put together, flexible, happy, energetic, willing to travel. These are all things that we look for, as well as the obvious, having a valid driver's license, being able to work in the United States, and having a really positive attitude.
Yeah. Okay. Makes sense. So from Keith here, even though the benefits are good, salary is good, you're having trouble. Is it because they want to do something different? I mean, do any of these women want to be a nanny the rest of their life, or is this something that's literally filling a 3 to 5 year slot until they can, find the gig in the regular market that they want? I think that's what Keith's asking.
Sure, I get that question a lot, actually. I tell our nannies that we're looking for a 2 to 5 year commitment per position. And the reason for that is a lot of our nannies are in their mid 20s to early 30s. And at some point they are going to want to go on and have families of their own. And sometimes it's hard to continue a nanny career when you do have children of your own and you can't bring them to work with you. So sometimes there's natural time out at that point where they'll go on and do something else in their field of major.
Got it. Here's a good one from Tommy in Chicago. What's the ratio of male nannies to women nannies that you hire? I always thought that there was no such thing as a male nanny, but I think you've told me you've placed some.
I probably place about 1 to 2 a year, but it's relatively uncommon. And typically the male nannies that we take are those that have backgrounds as teachers or coaches and who want to work in a different type of setting.
Yeah, got it. Okay. Well, that was eye-opening. I really appreciate your input there. I don't see any more questions, and we wish you the best. I can think of a few people I know that would be glad to jump on a $100,000 salary with 3 weeks paid leave and medical benefits, but they might not have the qualifications. So wishing you the best in Boston. Thanks for joining us tonight, Lydia. All right, take care.
Thank you again.
Bye-bye. All right, guys, in U.S. politics, red and blue we are, folks. It's pretty inescapable. All right, so this is Biden's day. He's addressing the nation literally as we are on this call. So again, the fact that you're hearing me say this means you've chosen to be on this show rather than watch the president. Of course, you can always watch the replay. So thank you for doing that. He's going to discuss the relief package. So here's my brief analysis of this. So with the Senate passing it and Biden signing it today, kind of ceremoniously, 1 year later, I think the GDP is going to surge. I've got some people in the industry that are expecting 6 to 7%. I'm going to bump that up to 7.5% annualized beginning 2Q to 2Q 22. Okay. JP Morgan is saying basically every $1 trillion of fiscal stimulus adds $4 to $5 EPS, earnings per share, implying about a 6 to 7% upside for the remainder of the year. I think we're going to be much higher than that. I'm seeing another 10 to 15% in the market. I'll get to that in the next section. U.S. stimulus, you were wondering what the price tag is. Well, this global surge, basically this 2.4 trillion, it's 1.9 right now, but I think there will be more behind this. Certainly there will be more with the infrastructure stimulus package. I mean, it's more than the entire economy of Italy, Brazil, Canada. That's just how big the U.S. is. But it is enabling us to drive the world economy, and these other smaller economies are grateful for that. That said, the debt will equal the size of the economy this year. In my entire lifetime, this has never happened, but now it's the case. The debt will equal the size of the economy. The budget deficit surpassed $1 trillion for the first 5 months, not on a yearly basis, just the first 5 months. I don't know how we're going to overcome this, but for now, with interest rates so low, we can make it. This is a graph of what it looks like. You can see that outlays and receipts is tax money from us, by the way. But the outlay, that's a huge spike, are these tremendous incentive packages that the Trump administration started, these relief packages, and of course the Biden administration is continuing. The debt is piling up so that 200% of GDP. I don't expect I'll be here in 2050, but those of you that are going to have to figure a way to pay for this. The problem is that politically, whether it's Republican or Democrat, no one wants to cut taxes. I mean, they want to cut taxes. I shouldn't say that. They don't want to go into a position where they're saying, we're going to get the deficit back under control and reduce the debt. So let me get that phrase correctly, because it's not politically popular to do. And that's the challenge when you're in a leadership position. But look at this as a share of GDP. I mean, we hear how we had to ramp it up over 100% to fund World War II. Okay, you can see World War I, Great Depression, World War II. And even then, it was just a little over 100%. So with the pandemic, we've equaled what the debt to GDP ratio was in World War II. But you can see on the right side of the screen, it's just going to go crazy beyond that. And the only way to get that down is to have the economy humming along at a higher than 6% level to offset, because when that happens, people are making more wages and there's more tax being contributed to the receipts that you saw on the chart, the previous chart. So what does the American public think of this? Well, if you look at all voters, about 20% say there's too much support, 45% say it's the right amount, and the offers too little support is also about 24%. You can see the Democrats, the Republicans, the Independents. As you would expect, many Republicans think that it's just it's too much support, meaning it's going to cost too much. But also 35% of Republicans think it's about right. So there you go. For the most part, America likes it. Now, this is an interesting map because we just have this calculated. What are the supermajorities in each of the states? Now, again, this is the political section of the program. So what you're seeing here is basically a slight realignment, and it's geographically something that we've known, that the center of the country is red and the coasts of this country are blue. Now, here they're illustrated in dark because basically they have a veto-proof majority. A veto-proof majority in the state legislatures means that there are enough votes to override a governor's override, meaning the legislator is going to get what they want. Doesn't matter what the governor wants because they've got 67%. So this is an interesting development. Again, it doesn't have immediate implications on investment choices, obviously, but it does set the stage for in this case, conservatizing of the USA. You wouldn't know that if you just looked at the US Senate, the House, and the presidency. So the population centers, again, you can see we have this political divide in America, as you probably know it. I'd never really realized just how poignant it was. So the population that's in orange is roughly equal to the population in red. Okay, obviously it takes a lot more red space to equal the orange space, but this political divide is the USA's 21st century geographical divide that essentially was there in the Mason-Dixon line. Now, why do I pay attention to this? You'll see this as I go forward tonight. But the political divide in America is more severe than at any time in my lifetime. As most of you know, I turned 66 recently, and this has to be something that we pay attention to as your investment managers. This is another issue. And again, I'm only trying to show this during the political section. This affects us as investors only in that it's taking resources away from other areas of the government. We have a porous, again, southern border. And it is eventually going to affect the entitlements that we will be handing out, doling out, if you will, to these people that come across the border and expect to have residency in the United States. And all of this will affect the deficit and the debt, which affects our investments. And figuring that out is, of course, what we're here to do for you. We had only one cabinet pick this week, so the Biden administration is still not pleased with the delays. You can see Merrick Garland, it was approved as Attorney General, but still, if you don't see a check, that means that they're still in the approval process, okay? And it's not going as quickly as President Biden would like to see, but President Trump experienced the same thing. So what is your biggest political concern? A, because the stimulus package is so packed with pork, it will not sufficiently aid the less fortunate. Or B, President Biden appears to be signing too much legislation too soon. C, President Biden appears not to be his own man. D, my main concern, and you can just write it in. And E, I have no concerns about the package, nor President Biden. Let me check the box here and see what we got going on in the comments. All right. Thank you for giving those questions, guys, to both Lydia and Tom earlier tonight. Where can I apply to be a nanny? online at, all right. You guys got some answers for me here? Checking the screens to see what else we got going. Answer E, no concerns about the stimulus package or Biden. Karen, Biden appears not to be his own man, and basically by that I mean he's basically getting walking orders from other constituencies within the Democrat Party. Charlie, no concerns. C and E from Tom in Lake Geneva. Okay, anybody else? Anybody else? I talked about the amount of pork, which is anything over and beyond the purpose of the stimulus package. So if we got a $1.9 trillion stimulus package, you'd think that, 1.7 or 1.8 of that would actually be for the benefits that it's intended. And it's not even close to that. It's more like 15%, maybe 20%. I'm going to have more numbers for you next week, but that's what it's looking like. Keith is in line with Karen and Thomas, I should say, with C. ABC for Tom, for Larry Wall, okay? Yeah, there's truth to that, for sure. All right, guys. Hey, Debbie, how are you? Good to see you. No concerns either way. Okay. All right, I'm going to move forward. You can keep sending your answers in if you want. So the third segment, as you heard from the opening intro, we're going to try to firm this up a little bit here in year two, the world economy, from COVID to the U.S. political scene, to the world economic scene. And then we have sub-segments within this so that it kind of all makes sense. When I present this much data to you, I'm trying to put it in segments and sub-segments so that it's easy to comprehend. And you know this chart, this is the year-to-date performance. Look at the Russell, just killing it. Second place, though, the Dow. The Dow lagged all last year. This is as of the end of the day yesterday. So this year, today's numbers were even better. So all these are higher. But coming in last place is the NASDAQ, which was the blow-away leader last year. So am I concerned? The answer is no. And why am I not concerned? I'm going to show you right here. I'm looking for more answers. So I got from Greg, this is on the previous questions, A, B, and C. Lynn and Carla Wall, okay. And Martha D, all the above. All right, I get you on that, guys. It's good that we're bantering this around. So, all right, so as a reminder here, as we go through this section, I'm going to show you the performance of each of our programs. I do this every week, but just reminding you, our investment philosophy is to periodically evaluate the 11 S&P 500 sectors and industry groups, and then select leading stocks from these leading industry groups from the leading sectors. Okay, that's what we do. And then we invest these with very few exceptions. Sometimes I will take a flyer, which is something that is off my pure methodology, but I only do that in CG, okay? We want to participate in momentum and invest where Wall Street is bidding higher. And thus we and our clients want to share in that wealth generation. How is that working? This is CG year to date. So we are struggling in CG, okay? And I am very transparent. This is my actual return. Year to date, we have not made the best calls here, and yet we're still up for the year. We're actually considerably higher than that because we made about 4% today. But that's what it was yesterday, and we want to be fair. SG continues to just knock it out of the park. It's 7.5%. We were at 22% earlier this year, but it's held up reasonably well in this downturn. DG, which is diversified growth, nice performance at 4.1%. You can see that's the blue line. The other indices, the S&P, the European markets, and then the Vanguard Total Market is on there. And then GI having a really good year. This is our conservative program. If you've been a client of ours for any length of time, you're in all of these, or one of these programs at least, sometimes two. Some of you are in four, just like I am in four. Okay, it's also having a good year, even though it's our most conservative program, again, because during the downturn, it didn't lose that much. And that's one of the reasons why people like GI, and plus they use it for income. So I want to go back to CG. For those of you that are having a little bit of a heart attack, this is what CG did last year, okay? 62.5% after fees, after commissions for the trading, etc. This is the net performance on CG in my own account. And if you guys have been with me for that whole year, you should be within 1/100% or so of my return. So pretty good. Okay, but the buzz today was going to be, is the S&P going to hit a new all-time high? It did. It took the Dow with it. It took the Russell with it. Now, the NASDAQ is still playing catch-up. I've been talking about that. But great day. S&P rallied back nearly 6% in less than 5 days. Just a week ago on this show, I could just tell people were kind of heavy. And it's like, oh, this is going to be terrible. No, it's not. We're in a secular bull market. You just have to believe me on this, folks, okay? So to me, the reaction in this turnaround from this correction, if you will, which is only 11.5% in the NASDAQ, and it still hasn't fully recovered, but that was the low. I guess depending if you look at the NASDAQ 100, it could have been 12.5. But this correction looks healthier than the last one, okay? To me, it does anyway. This is what the Dow looks like over the last 6 months. This is what the NASDAQ looks back. So it has had this little bit of a pullback here. Not a huge problem. Not concerned about that. You see the green area where support came in and the buyers came in. Remember, in a secular bull market, guys, all asset classes have to win. The NASDAQ might win for 1, 2, or 3 or 4 years, but eventually, if we're going to keep this going, we want all asset classes to win. The most important takeaway is that we have a massive uptrend in place, which is extremely bullish. The NASDAQ is up more than 130% since the low of the fourth quarter trade war scare, if you remember that, with President Trump and China, etc. The NASDAQ has nearly doubled since the pandemic low of March 23rd, and I believe that low is in our rearview mirror. We will never see that low again. I've predicted that before. I stand by that. Those who didn't believe this secular bull, guys, I don't know what else to tell you. I just continue to see it. I hope that you'll join with me in that. We are going to have pullbacks. We may even have a cyclical bear market during this, but the secular bull goes on for probably 10 more years. Look at days when the NASDAQ is down 2% and the Dow is up. Look at it from the perspective of the Dow on the left-hand side and the NASDAQ on the right. It's few and far between when the Dow actually outperforms the NASDAQ for any period of time. You can see it there in 98, 99, and 2000. And then you can see it literally the last few days here. But guys, it's an anomaly. It's an anomaly. That's why I'm not jumping ship at people. One of my advisors said, are we going to rotate the value? You know, I'm thinking we need to do that. And I'm going, no. I don't know how else to say it. I hope this is helpful, guys. This is what it looks like. I didn't want to put a bunch of numbers on the screen. This is the NASDAQ versus the Dow versus the S&P versus the Russell over the last 16 years. The NASDAQ's the blue line, okay? It's lagging now a little bit. See how it pulled back there at the very end? More so than the other indices? That's good. I know it seems crazy. It's good. Why? We have to have all four major indices and thus asset classes participating in this secular bull market. Have to, or it won't continue. So this is a good thing. Seasonally, I don't talk about seasonal performance, but look at this. Look at the yellow here. Yellow is on March and yellow is on June. The NASDAQ doesn't like March and June. All right, and we're in March right now. Look at the yellow highlight here. This is IWF. So this is growth. This is the comparison of IWF versus IWD, which are two ETFs that are growth and value, okay? Don't worry about that. What you can see is March is usually a relatively down time, as is June, okay? And if you look at the first month performance on an annualized basis, 2.8, almost 3%. Second month, 3%. Third month, minus 0.8, almost 1%. And this is 50 years worth of data, guys. This is stuff I study, and this is why I have the confidence that I do to tell you guys what I tell you, okay? A lot of gobbledygook on these charts, but basically the growth IWD versus or IWF versus IWD on the left-hand side, the NASDAQ versus the S&P 500 on the right. We're going through a correction cycle in growth stocks. That's the takeaway from all of this. And what you've seen Tuesday, not so much Wednesday, but definitely today, are the growth stocks coming back. All right, and I believe that it's going to continue in this direction. We'll see if I have to stand by that next Thursday night. I want to do a shout out to one of our viewers. I've tried to encourage you guys to send me stories, send me data. And this particular guy sent me a stock. He said, I was looking at GE and I saw it made a big swing. It looks, kind of close to closing in. It looks like they're going to close on a big deal. You probably know that. Actually, I'd been watching it, but I didn't know that particular bit of data, so I thought I'd put the chart up here. GE is actually broken out. You can see the price chart over there on the right-hand side, and I responded to this viewer, hey, it's been trading under $6. But anyway, I just want to keep encouraging you guys to send me data, all right? I appreciate it. Today's feature stock, Tesla, you've heard me talk about them before, but probably not for this reason. They're in a gigantic battery contract to create for the city of Houston enough power so that they could power 20,000 homes on a hot summer day as a backup. I mean, imagine the number of volts that takes. It's just staggering. There's this parallel business going on with electric cars, but a subset of that are the actual batteries that power the cars that are now possibly going to be powering a backup here in Texas. All right. Anyone that has not really been paying attention to Tesla, when they just went crazy on Tuesday, just 2 days ago, guys, they were up $115, 20.4%. Now that is something you'd expect from a small cap, but this is a $540 billion company, $500 billion. And it equated to a $110 market cap gain that day. And I put in yellow here, the increase is greater than the entire market capitalization of all but just 72 stocks in the S&P 500. Why am I making such a big deal of this? Because Tesla's in two portfolios. If you have SG and CG, then 6% of your net worth is in one stock. Why? Because of this kind of performance. Okay? This is what I track. This is why we stay the course when these downturns happen. In economic indicators, guys, I know we're probably going to run a little bit long here. I promise next week we'll get back on time, but there's so much to tell you. GDP forecast continues to rise here. I love the trajectory of this chart. Don't worry about the numbers. The chart is heading where we want it to for the future. Basically, business confidence. One of the reasons GDP is going to continue to rise is because CEOs have the highest level of confidence since 1983. Take in that yellow highlight and really imbibe that, okay? CEOs, business confidence, highest since 1983. Do the math on that. That's almost half a century, okay? It's just coming out of a pandemic, almost hard to believe. Real disposable personal income, I've mentioned to you before, Fred, the last name is not Flintstone. This is Federal Reserve economic data, okay? Showing that disposable personal income is at a high, at least a high for the last 10 years. Change in employment status. So you remember that the leisure and hospitality industries have been beaten down so badly. But look at the change here from January to February. Remember, all asset classes have to participate to keep our secular bull market, and all industry groups need to eventually start hiring so that not one or two or even five industry groups support the whole economy. So when I see this comeback in leisure and hospitality, professional services, healthcare, retail, guys, this is great. This is great news. And frankly, I like seeing the loss on the government side. Okay. So that's a positive, really big positive. Small business job openings. This is just what Lydia was talking about. Got these openings, cannot fill the positions going all the way back to before 1992. Simply have nobody to fill positions and jobs waiting. I wanted to touch on inflation a little bit because people are talking about it. It's kind of like when you see in Barron's Magazine or Life Magazine, or in the old days, or whatever it is today on social media, that the market is just now getting hot. That's probably the time you need to get out. People are just starting to talk about inflation, so I would take that as a sign that we're not going to have a problem. And here's why. February CPI basically says not an issue. The key takeaway is that, there was no headline surprise. Maybe there's going to be something to fan the flames down the road, but right now, just not an issue. And the Fed is monitoring it. They want to see 2% year-over-year inflation, and they can't even get to that target, guys. 2% inflation is a great number. 6 or 7, not at all, okay? So why is this happening? Well, we have an inflation in prices and appliances. We just put a new dishwasher in our home, and it was like 3 months to get it here. Okay, why? Prices are high, they're in demand, people are staying home. Again, it's the stay home economy. This is what we're doing for you, is finding out where these opportunities are with the change in proclivities, word of the day, proclivities of the American consumer. Same thing for, I love these charts, indoor plants and flowers, 9.5% inflation. Why? Corners of the home, people are making their homes look beautiful because they're spending all their time there. What's getting hurt? No inflation with men's apparel. Look at the chart. Okay. I wear kind of the same old pair of sweats and shirt around, except when I'm on the show. But, they've been affected by it. What are they going to do to pull out of it? We're going to wait and see. They're going to have to figure it out in that industry. GDP projection, look at the strong blue bar here, just really looking great. I've suggested earlier tonight that I think this is going to be more like 7.5. Many economists predicting 6 to 6.5. I'm above that because of the data that I'm seeing. And then this chart, my favorite one, I think this is the final one for the quarter. I don't think there's any way this number is going to come down to 73. We started at 90. We came down. Look at the top number there. It's highlighted, 79%. What we're looking for is the number of S&P 500 companies that are beating their estimates. All right. 79 is a great number because 73 is the norm. So this is 79%, still in a pandemic, still with huge unemployment. Guys, this is great data for U.S. corporations, okay? In the housing market, not a whole lot changing here other than the move to residential. Look at this construction led by residential design. ISI home builders survey. So what do the home builders think? What do they think of their future? Like the CEO optimism I gave you earlier, this is the home builder optimism. All right. And then finally, construction spending. You're seeing a huge bump here in residential and a huge drop in non-residential. I don't hear of a whole lot of real estate investment trusts building new property until this whole shakes out, this whole mindset of, where we're going to work from. We're going to work from home most of the time, some of the time, all the time. You're going to see this trend continue, in my opinion. In the random data department, I just have one for you here. I really like this. I won't quiz you because if you can't see this, you're really not paying attention. But look who the number one employer is in about, 2/5 of all the United States, including our state here in Tennessee. Yeah, Walmart. How about that? Just thought an interesting data point. So again, it's random. That's the whole point of that section. So Crypto Corner, you guys asked 2 weeks ago, said we want to know more about crypto. So I'm going to do this every week, every Monday show and every Thursday show. Visa has now jumped into the space just like MasterCard did, launching a pilot program that will provide banks with crypto APIs. That's application programming interface. So basically, if you want to connect to their bank, they're going to make it possible for you to connect with crypto. First Boulevard, pretty good sized bank, is basically the first one to sign up. They're following in the footsteps of PayPal and Square, and as I mentioned, MasterCard. So you're just seeing greater adoption to crypto. That's the takeaway from this slide. Now, there are always people out there that say, Bitcoin has no intrinsic value. It's just a computer algorithm. Well, some people are okay with that, and I'm okay with that because maybe it's a theoretical value right now, but it exists. It definitely exists. You might not like the fact that you can't touch it and hold it, but there are plenty of things that have value that don't have any intrinsic value. A diamond, for answer. You can cut things with it, but other than that, it just looks pretty and people have assigned a value to it, whereas gold can be used for industrial metals and certainly silver can be as well. So I wanted to make you aware of this, and this is not something I'm suggesting you do, but this is becoming an increasingly popular trend where you can actually deposit. So think of CDs. You give them your money and they give you 1%. Well, now these crypto savings banks, if you will, you got to be careful because it's not actually savings. You can what's called stake. So think of a stake on the ground, right? And you can put your coin there and they give you interest, 5.2, 6.9, 33% loan to value. I mean, it's just kind of crazy, okay? But that's what's going on in the crypto space, all right? American energy. So this is a new segment that I will be starting next week, and I'm expecting this to go 5 to 6 weeks. A lot of investment opportunities here, and I want to talk about this. So the American energy portfolio is something that I'm sort of envisioning here. One of our listeners brought this to my attention and said, we really have a portfolio of energy in this country. The first is fossil fuel, which is coming from coal, oil, and natural gas. Okay, hydrofuel, and you got the little energy sign right here, water, and we haven't talked about that at all, but we will. Each week we'll spend time on this. Obviously, natural wind energy, solar fuel, and then of course nuclear fuel. All right, nuclear fuel is very controversial, but we're going to show you some really cool developments in small scale nuclear fuel that I think will interest you a lot. And basically, at this moment, fossil fuel is still what powers the USA. Now, we realize this is a political issue, but it's also an investment issue. And I want to educate you guys on this, and we're going to take the next 5-6 weeks to do this. There'll be a sub-segment within the world economy, the next 5 to 6 segments, okay? And here's the breakdown. I'll go into a lot more detail on this next week, but I just basically wanted to whet your appetite that we're going to have that. Now, 2 weeks ago, you guys said you want to know how we're going to make investment decisions going forward, and how do we know when to buy and sell? Well, I've come up with a way to visualize this, and I'm calling it investing in post-COVID America. It's a little bit too complicated, and we're running long to be able to explain this to you, but basically, I see this country as, in a simple way, let's go back 500 years. You see the village that's surrounded by this moat, protected by these guards. And you see the small icons there of the people doing their various things. That's how I envision a pure working economy, a capitalist society where people can create goods and services and widgets and baked pies and horseshoes or whatever were doing 500 years ago. And it's very different and more complicated now. But the purpose of having that wall and moat and having guards to protect you is not to have that guard and moat influence how you're conducting business, but to protect you so you can do business. So to me, the biggest threat that we have in this country to inhibit our ability to freely invest and buy and sell companies and stocks, which is what you guys pay us to do that are clients, is to have an environment where this is sustained and perpetuated. It's probably going to take me half a year to cover this because it's such an important topic. So count on that as being a sub-segment starting next week. And in many ways, guys, it's a choice between, here's the COVID icon in the background, capitalism and socialism. Now, there are, as I'm sure you know, there are some pretty loud voices that are wanting this country to take more of a socialist bent. I am not one of those. I believe that we have a great system, that our founding fathers created a great system. We can always improve on it. But because you guys hire me to manage money for you, I have to talk about the bedrock of what we do. It's not earnings. It's not, you're going to see the question in just a few minutes, so I'm kind of giving that away. The most important element of what we do as investors is having a safe, predictable, reliable platform to invest on, and that is a capitalist economy, okay? So this is from George Friedman. This is a guy I've been reading. Thank you to one of our listeners who gave me this book and this guy. I want to read this because I think it's important. Our founders did everything they could to ensure the liberty of private life, and for all later intrusions, they've succeeded. The great things occur in private, in places where the founders meant for us to live. A president nor a Congress nor the Supreme Court will change that fact. So for those that want to be outraged about what I just said, this is George Friedman talking, by all means, please be so. The founders protected us from excessive rage by worship at the altar of private life. In other words, our private lives, our private decisions about what we want to buy and sell and invest in is far more intimate and authentic than posturing of public life. That's kind of wordy, but we're going to take 6 months and we're going to dig into this, guys, and make sense. So last question for the night. Thanks for hanging in there, guys. I really appreciate it. What is the biggest roadblock to my success as an investor? And it's really important that I understand your answers. So Alice, if you're on, please take note of these, okay? So what's the biggest roadblock? A, earnings reports, balance sheets, management of U.S. companies. So that's what you, if you check A, think is the most concern. B are more economic issues, poor GDP, economic data, housing data, retail sales, and other economic data. That's the biggest roadblock as an investor. Answer C, capitalism losing its positions as the bedrock for the way of life in America. D, just write in what your biggest concern is. Or E, you don't have any concerns. You think we're just on a path right now, but it's just okay. So, okay, there you go. I will watch for your answers. Tom, thanks for being part of the show. I see you had to sign off at 8. And I am running long, guys. Seriously, for season 2, my goal is to do this to 50 minutes, 50 every week. Appreciate you guys hanging in there, waiting for your answers, and then we will say goodbye. But appreciate you being part of this tonight. So, what do I have here? Anybody? I see from the previous answer, Dennis, A and C. So E? Okay, Dr. J, that's good. I'm glad you don't have concerns. That's great. Karen, C. Okay. I share that with you, Karen, and Greg. I share that with you as well. C. And we're going to address that, and this is going to be very interactive. I want you guys to know that not so much on the energy section, but on this, investing in a post-COVID world, this is going to have multiple questions. Think of it as like a little, seminar and then discussion after that. So like 20%, 25% of my weekly show for at least 3 months will probably be this understanding investing in a post-COVID world. I got lots of C's here. Debbie Gomagowski, Larry Wall, Keith. And that doesn't surprise me, guys. Keep sending your answers in. I'm gonna move forward in an effort to just get us out of here. My summary for tonight, guys. I always read from 2 Timothy 1:7, and I'm going to continue to do this in season 2. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. It remains my deeply held belief that we will not only survive this pandemic and 2021 in general, but we're going to emerge a stronger nation, stronger people, better investors, and I still think the best days of America and for our lives indeed are ahead. I really do, guys. I am super excited that we made it through this first year, but even more excited about season 2 because we're going to dig deeper into some more topics. We're going to be able to shorten the COVID section because candidly, we're on the other side, and I'm real encouraged about that. So that's where it is, guys. I want to thank you for being here tonight on Thursday, March 11th, the 1-year anniversary of CB3 Live. Means the world to me that you guys are with me here watching this program. Tell your friends, okay? Tell them to go to YouTube, sign up, subscribe, click that bell. And we're going to be covering some really interesting topics. I think it'll be introspective, so it'll be educational for you, but also introspective. It may challenge some of the ways you think about things and how we invest as Americans in post-COVID America. I will plan on seeing you in a week. From COVID to the U.S. political scene to the world economy to clarity. This is CB3 Live. We'll see you next time.